sometimes the best things happen and come out by accident. And I think that is true. In this case, this is, it doesn't matter that much, trading systems in general compared to the world at large. But in this case, I have the same thing here where I copied and pasted this code and with the dates, and it was a mistake. But actually, I looked at the results and they were phenomenal, and I'd like to share what it is. Essentially, it's buying or selling at the contract of ES. There's quarterly contracts. They last for about 3 months, and that's what these bars are. These are the actual contracts. So if someone, a big dog, wants to buy or sell and trade with a very long-term perspective, this is what they're holding. They're holding these actual contracts. Now, what I've found is that by looking at the contract and the contract expiration, if you can see the calendar here, the third Friday is when it expires. Okay, 1, 2, 3. And what I've found is that if you start a breakout, meaning if you put a rectangle on the first date that I'm going to tell you, a rectangle, right? A small rectangle, right? And if it goes up above that rectangle, you buy it. If it goes below it, you get stopped out and you go short. So it's a stop and reverse rectangle. And I don't know, you can call it a breakout box. I don't really care what we call it. But that's what that is. And what the dates I messed up is this Friday, the Friday before the expiration is actually when you start the breakout box, and you actually allow whatever that rollover volatility to happen, so that you basically trade 1 week. You trade and hopefully hold on to the position for a long time. It's not high frequency or anything, but basically Friday, and you allow the rollover week to happen, and then you get out at rollover. So essentially, we're betting on that last week of volatility, something to be volatile. Sometimes it can chop, which wouldn't pay us, but sometimes it might move directionally. Excuse me, geez. Directionally. So then either the contract holder is losing less on the contract or making more on the contract. It's just that last burst. And I think that there could be volatility there. And I did not plan that, but I ran it. I run it again. Basically, you can see it's September 12th to September 19th. That's literally what I just highlighted, 12th to 19th. That's literally what it is. It's so interesting that is what we're doing. I just want to see the start time. Just make sure it's market open. Yep, at 8:30. Great. So here are the results. You can see the results are pretty good. Pretty good. I mean, really good. I mean, it's up and then it's flat, flat, flat up. But in general, I'd rather be on the upside of this because there is limited risk to the downside. The only way you can lose is losing diagonally like that, small and diagonally. That's how you can lose. You can win going vertically, and that's what small losses, big wins look like. Boom, 28 grand. Small loss, big win. Small loss, big win. That's what this strategy is. And there are plenty of times where it goes up in value, but we don't get out. This one up $2,800. We don't get out. We lose on that trade. $3,000, we lose on that trade. $7,000, we end up getting $5,000 out of it, $6,000 out of it, because it happens to be at the end of the contract. We hold not in terms of dollar amount, but rather in terms of time. We get out at the end of the contract. at the rollover date. And oftentimes it does push in one direction. This one went $7,000 in one direction. We get 6 out of it because that contract closes near wherever it's heading towards. The momentum just keeps on pushing that way. In those cases, this one went up $5,000. We're still losing $375 on that trade. That's not what I would do. I would put it to break even at least, but still, I mean, it goes $5,000 and you're letting it run. You're letting it run because otherwise, how are you going to get that $11,000 out of it? So that's what this system does. I like it. It's actually just trading 1 week. And let's see what's happening this week because today it's supposed to close. You can see that the breakout box is here. The breakout box is here. And it's kind of hard to see, but basically you go long, and then you get stopped out. You go short, you get stopped out. You go long, you get stopped out. You go short, you get stopped out. You go long, you get stopped out. And then you finally go long here. You go long there. And we've been long ever since because if it happens to be outside of this box, you're going to be in a position. You're guaranteed to be in a position. So if it does rally more than this, we'll be up money. But at this point, we're probably down money from this week. Oh, we're good. We'll probably be down money this contract. So let's see what this contract is. 375, yeah, loss. And then this one's up 1,300. We were up 2,300 at this point. So in this rollover week, it does seem to be chopping. So this one was probably going to be a negative time. But we could plot out all the contracts, and I think that would be interesting. So I might do that right now. I'll get back to you. All right, peace. Okay, so I ran each contract and found the profit on each contract if we were to do this. Remember, we're trading the week before the expiration. We're doing a breakout on this week, essentially. The start of the week, I want to see if it can move directionally and we can be in that movement. And you can see from the results, I expanded it also another 2 years. So 2020 through 2025 here on the left. You see this is net profit. This is the drawdown before you find your win, meaning you lose, win. That's what happens with this system because you don't have a target. You just ride it until the end of the contract, and sometimes the end of the contract does produce profit. And you can see that it was pretty poor performance at the start, and then it started to become better as time went on. You're up 10 grand with all these different contracts. This is not a profitable trading system. I thought it was going to be better because we were only looking at, the last 2 or so years. Now, I mean, given 5 years of data, we do not see profit. You can see that you lose money most years, but then you can have a knockout year. That's not good. So what am I looking at? I'm looking at when I win, let's say over 4 grand, there's one. I just want my wins, right? If I could, in a perfect world, just have wins, that's what I would like to do. So now I look at the number of trades, and if I can see this, the number of trades on the right-hand side here, you can see all of these trades are less than or equal to 5 trades, literally 5 trades during this week. All the rest of the big losers, 31 trades, you're losing 11 grand on one contract. You clearly are wrong. We're clearly wrong. We're in a time of just chop, and you can't, there needs to be a limit of how many trades we're going to take because we only risk 375 every single trade. So if we do lose, it's 375. It's small losses the entire time. So if we want to lose less, we don't trade and continue to lose. So if you can look at it, if I were to cap the amount of loss I can take to 5 trades, the maximum loss I can take is 5 times 375. And in this case, it would be definitely profitable because you can see that the biggest wins are actually the times where you trade the least amount of trades. And that's substantial. So you basically give your system, I would give this system, 8 trades to find a good trade, or 10 trades, or even less. I probably wouldn't go more than that. I mean, obviously we can't say, 5 is the number, just because historically it has been, but it can be 6. I mean, sometimes I'm sure it can be like that. But basically, we don't want to keep trading this if it's not working. So the idea is to allow it to trade a few times. And if we happen to capture it, we do. If we don't, fine. We take our loss and we take our 5 times 375, which is 1875. So on all the lost ones will be negative 1875. You can see. Let's just do that quick. Hopefully I can do this pretty quick. Basically, anything over 8 trades, I'm losing money. And that's going to be a lot more often that we lose. But in total, we might be able to actually win the entire system. So let's just do that quick. Okay, and then the rest of them is the result that we get. So let's just do this quick. And obviously we're nitpicking this because we already see the data, but this is part of back testing, is to see, well, what could have worked. And in general, it does give us an idea of what we should do. That's the whole point. So in total, what do we get? We get 20 grand in the sum here. So that's not bad. That's a whole lot better than 9, and you trade less, and you have less risk overall. You're not ever going to lose. You're not ever going to lose more than 1875, more than 2 grand on any one contract. And over the past years, it's made 20 grand in total. So that looks fantastic, honestly. That's a great system, in my opinion. I like the idea because there is capped risk. You know your risk, and there is unlimited reward. There could be a time where that rollover week happens to be a lot of volatility, which happened in March of 2022, which happened, 5 grand, 3 grand. Those are good numbers to have if we have a 2 grand risk. So I like that idea. The next thing I'm going to test, I'm just going to make this a long video, but the next thing I'm going to test is actually the very first week of trading. So this is the end. This is the end of the contract, the last week of the contract. I want to test the first week of the contract now and see the difference. So that's what I'm about to do, and we will see the difference. All right, peace. All right, I just finished the comparison between the first week of the contract and the last week of the contract. Which one perhaps can be more directional from the start of trading? Let's say the first week of contract, we're starting on the Monday at the contract open, going to the Friday, which is 1 week of trading. We exit on Fridays. And what we get out of that is 17 grand in comparison to the 9 grand you get with the last week of the contract. Same strategy, last week versus the first week, and the first week does win, but this is not a good system. You can see that the drawdown is intense before you pick up a win, and sometimes like June of 2024, you didn't pick up any win. You just chopped around for 33 trades. Complete nonsense, and it's kind of what's going on right now as we speak. It happens to be the last week of the contract, but the same idea. I want to show you, just based on a familiar chart here. The line there is the start of the contract. So we'd put like some type of box here, like this, and we'd say, well, if it goes up, I'm buying. All right, let's see if it goes up. Nope, it doesn't, so it goes down. All right, I get out, I lose $375, and I go short. And this one happens to go back up. I go long. I go short again. So that's an exchange of 375 times 2. And I'm short now. And we go really far down. We go really, really far down, but it happens to go back up. This is, I don't know if you can call it chop, but it's volatility, but it's not very directional. This happens to be FOMC, of course, but I'm not accounting for any announcements. I'm just allowing it to do its thing. And what the data tells me is that it's not consistent enough, whether it's the first week of the contract or the last week of the contract. It's not consistent enough to bet on directional movement unless you know that direction. Then that's perhaps fine, but you have to have a stop loss, and I have a stop loss. Like, I just don't see that it's proper to do this system. It's not good. So I did optimize. I did say, all right, I spent this work. I'm going to at least try, let's say, getting out at 5K. So you see today or yesterday or so when the FOMC hit and it goes down, we were on that entire ride down. Depending on how much money that would be, we get out at $5,000. We get out at $10,000. And the move itself was 56 points, so I don't know how much money that is. It's $2,800, so it would not have gotten us out. So we would still be in this contract. But I got targets at $5,000, $5,000, $10,000, or $15,000 if it happens to go that far. And I'll be honest, it doesn't make money, either one. So none of them really make consistent money. The $10,000 one and the first week of the contract is better. It's better directionally. It does seem to do that. Just saying. It does seem to do that, but it seems to do that. And during the first week of the contract, it does seem to be more directional, although it's absolutely not good enough to trade, but it does seem to be more directional than the week before it closes, which is a little bit different to me. I thought the week before it closes, people want, the big people in this who will buy the contract or sell short the contract, they want that close of the contract to be maximum. It's just like you're in a trade and you're at the end of the day, I want that thing to go as far as we can at that end because the expiration is now. And I would expect the same. I would expect that. I would expect direction. I would expect a magnitude move in a direction to better the bottom line of the contract holder. And we do not see that consistency. We see it okay, but it's not consistent enough. I mean, you get some serious months that just do not do that. So I can't condone this system, even if you set targets. I cannot condone it. And then during the first week of the contract, which is kind of the opposite, the opening of the contract, I would expect more order shifting around. I would expect back and forth, and we do get more back and forth on the earliest part of the week. But then if you do see a move on Wednesday, Thursday, Friday, then that is a good idea. That could be conclusive. So that's what I get from this. And the reason I picked that up is because the number of trades that occur seem to be fewer in the first week of the contract than the last week of the contract. If you just trade the first 5 trades, you'd be negative. Actually, trades. Excuse me, I said that wrong. It's very confusing. Sorry, but the first 5, let's say you trade 5 times, right? You'd be negative $12,000 in this study on the first week of the contract. What that means is there's chop originally. It's straight away chop right away. And it's more directional right away if it's the week before rollover. So I know it's confusing. It's look, the last week of the contract, the first week of the contract. The first week of the contract, the beginning stages of that contract open is generally non-directional. Okay, that's what the study shows. And because we have negative edge for the first 5 trades, if you just trade 5 times. Now, if you hold and keep on trading the first 5 trades, say Wednesday, Thursday, you might get moves at the end of the week. And I think that that's why we see big numbers here, because the big numbers are coming from 9 trades. I mean, you have to take 9 trades before you find the big winner, 6 trades before you find the big winner, 9 trades before you find the big winner. So there's more of those that happen at the closer to the end of the week. So, and that kind of makes sense. That's in line with my hypothesis too. So the first week of the contract does do some chop in the beginning stages, and then you may see trends form in the later half of that week. So that is important. And then the last week before the contract ends, if you're going to see a directional move, if you're going to see what I'm thinking of, like, oh, the contract holder needs to they want as maximum money as possible, so let's extend this thing. You're going to see that on a better basis, more edge would be they bet on Monday, Tuesday. They bet on the start of the week. The start of the week, if trends develop on the start of the week, that's good. That's a good trend. You shouldn't bet on trends happening Thursday right before expiration. And that's what's happening right now. The shorts tried it, broke. The longs tried it. This is Friday of expiration right now, and the longs tried it, and it's coming down. It's just not really extending itself. This is where the contract's going to land, likely, very likely. So that's what we think. So in general, if I would optimize this even more, if I would go even more in depth, I would say the last week of the contract, if it's not trended, I would bet on mean reversion. I would bet on it coming where it has been. That's what I would bet on. And in the contrary, if it's the first week of the contract, if it has not moved yet much in the first Monday, Tuesday of the contract open, that's the time to start looking for whichever trend it wants to form. If it breaks the high, goes upwards, you wouldn't want to sell short that high. You'd actually want to bet on the trend forming. So the first week of the contract, the first couple days shifting around, and then it starts to develop a trend. I like that trend. I condone that trend. I like that. That's a good idea. So we can develop a system that actually does it, which is probably what I would do, because it does get confusing and you have to be, paying attention and stuff. But I think that's the results of this study. That's what we can take away from it. So, but overall, no. Right now, it's absolutely not tradable. Absolutely not. I would do something way more specific, like I just talked about, where we mean revert or retrend during that specific time. That might have edge doing that. And you do it, once every quarter, right? Because each contract, you just trade each contract. That's the time we turn on the system. And I like that idea too. I do. All right. I hope you enjoyed it. That was a great analysis. We're going to go into find more analyses later down the road. All right, mate. Peace.